Thank you, Deborah.
Okay.
Meeting is being recorded.
So you can go ahead, Director Lane.
All right, so welcome to the East Bay Regional Park District Board Finance Committee's regular meeting at September 24th, 2021. And we are meeting remotely because of an entitlement provided for us by the governor. And we hope one day soon to be able to meet in person. If you want to, if there's any public here that wants to talk to us as a public comment, please contact Caitlin Stone at cstoneebparks.org. And with that, two directors who are here, would you like to do a roll call, Caitlin?
I'm happy to. And at this time, we do not have any public comment, but I'll keep checking as the meeting goes on.
Okay, thank you.
So I would like to start with Director Eccles.
Present.
Thank you. And our committee chair, Lane.
Present.
Thank you so much.
And then Deborah Ocker, our AGM for Finance, would you like to introduce a couple of people before we start? And then we'll turn to you later as well.
Thank you, Director Lane. I'm Deborah Ocker, the AGM of Finance and Management Services and the CFO for the Park District. And with me today, I have Deborah Spalding, our Assistant Finance Officer. We also have AGM Jim O'Connor of Operations and and our General Manager, Sabrina Landreth. We also have several members of our Finance Department staff, and our CIO, Jim Tellerico, is here. We also have some consultants with us today that I will have Deborah Spalding introduce them as we get to their items. Thank you.
All right, thank you very much. So let's begin with the first item, and all of our items today are informational. The first is Calpers Retirement Plan, Actuarial Projections, and Update.
All right, I just started sharing my screen. Can you guys see that all right?
I can.
Excellent. I'm Deborah Spalding, Assistant Finance Officer. And so I'm going to start out by giving you a little bit of background on the Calpers Retirement Plan. And then I'm going to turn it over to our consultant, Mark Schulte, who's here from Van Awarden Associates. So Calpers, which is the California Public Employee Retirement System, is the largest public pension fund in the United States. And apparently we just crossed that threshold recently and became the largest pension fund. Assets are approximately $466 billion. They have over 2 million members in approximately 2,890 agencies. And so a little history about Calpers. Back in 1998, it hit a remarkable funded status of 138%. And at the time, things looked great. And benefits for employees were, in some cases, optimistically, in some cases, unrealistically expanded. And shortly thereafter, the dot-com bubble burst and the stock market lost a lot of value. And then that was followed by the Great Recession of 2008. And Calpers assets lost significant value, and the funded status hit a low of about 61%, which was kind of risky. I remember them talking about their concerns if the stock market continued to go down, that they might not be able to fulfill obligations to the retirees. So a lot of changes started to be made at that time to the retirement plan, some of which were very technical, and Mark will talk about some of that, some actuarial changes, some funding strategy changes. And then at the policy level, PEPRA was enacted, which stands for the Public Employee Pension Reform Act. And so you'll often hear that term. And basically PEPRA members are those employees who are hired after January 1st, 2013. They have reduced pension benefits. So that's a requirement by the PEPRA law. And that makes them less costly for agencies and easier for Calpers to manage those benefit payments in the future. And that's because those costs for the retirement, because the investments weren't able to provide that funding anymore, agencies were having to pay more. So the PEPRA employees sort of eased that. And as more PEPRA employees are hired, it sort of eases the burden on agencies and on Calpers. And so overall today, or as of June 30th, 2020, I should say, the overall funded status for Calpers was about 70%. And then we're going to speak specifically about our plans later on. So here's an overview of our own plans. We have our miscellaneous plan, which is our largest retirement plan, and that has our AFSCME members, our police association non-sworn members, our managers, and our confidential employees. And that has a funding of 2.5% at 55 is the formula. So you get 2.5% times your last 3 years of service times the number of years of service you have if you retire at age 55. And then for PEPRA employees, you can see it's a little bit less generous, 2% at 62. And our plan as of June 30th had June 30th, 2020, had 604 active members, an average age of about 47 and about 10 years of service. And then our sworn plan is much smaller. They have a different formula of 3% at 50. PEPRA is 2.7 at 57. So 38 active members with an average age of 45 and about 16 years of service. And so now I'm going to turn it over to Mark, and he's going to give you a lot more information and talk to you a little bit about what we can expect in the future from Calpers.
Thanks, Deb. I'll share my screen now, and hopefully this will go smoothly. Okay, can everybody see the presentation?
Yeah.
Good.
Yeah.
Okay, so my name is Mark Schulte from Van Iward & Associates, and we are the actuaries that consult with the district on your Calpers plans, your OPEB plan, and also your older pension plans for general employees and sworn safety. But today we're really focusing on the Calpers pension plans that you have. And we're going to cover a number of topics. I'll try to be as brief as possible while providing necessary information. A little bit of actuarial background. We definitely will get into some technical topics. We'll keep it as much in layman's terms as possible. But pensions are complicated items to deal with. Talk about the plans themselves, Calpers contributions, and some of the changes on the horizon. And then some different funding mechanisms for Calpers plans, including a pension stabilization trust and discretionary payments. And finally, kind of a look out on the horizon of what's coming down the track in the future. So to begin with, in our actuarial discussion, one of the terms we're going to talk about is the actuarial accrued liability. And that's really the value of benefits that have been earned by all of your members, both active members and retirees to date. And another term is the normal cost, and that's the new liability that's earned each year. So you can think that over time you have an accrued liability, and then it just grows as additional employees earn new benefits. And of course, the liability also decreases as you pay out monthly payments to retirees. But the main calculation that we look at for these pension plans is to compare the accrued liability with the assets that are on hand. And then the difference is called the UAAL, the unfunded actuarial accrued liability. So for comparison, for your miscellaneous plan, you have about $382 million in total liability, and that's broken up between $268 million of assets, and then about $115 million of unfunded liability as of June 30, 2020. And that's the most recent actuarial reports that Calpers has produced. They were released a couple months ago. Also note that the normal cost, the amount of new liability that's earned each year, is a little under $6 million currently. So that's one component as we get into the contributions later. The normal cost is always a component of the contributions that you're supposed to make to the plan on an annual basis. Next is pension financing. And this is an item we talked about on the Calpers plans in a meeting 2 or 3 years ago. And we had an example there called the pension buck. This is something that Calpers publishes each year that shows for every dollar of benefit that's paid out, how much is paid for by investment earnings versus contributions from employers and members. And due to the compounding effect of investment returns, that for each dollar paid out a few years ago, almost 60% was from investment earnings, and the rest was financed directly through contributions. Their newest pension buck is a little bit different proportions, some due to actual investment returns, but also their expectations about future returns. And here we see that it's now 55 cents of each dollar paid to a retiree is through investment earnings, and 32 cents from employers. And then the member contributions are about the same. And this is a relationship that needs to be understood, that if you're required to pay out pension benefits in a defined benefit pension plan like this, that there's a trade-off. There's two sources of financing, either contributions or investment returns. So if one starts going down, namely the investment returns, you need additional contributions to make up the difference, because you're not allowed to just decrease the benefits that have been earned or that are being paid. Then this is a slide that I think Deb spoke to a bit already. I won't spend much time on it, but PEPRA. And this is really a game changer for Calpers back in 2013, where they were faced with a lot of increasing pension costs. And there's a discussion of how do we manage these costs, especially when benefits that have been accrued to date are protected, and promises that have been made to participants who are currently employed, those are protected as well. And so their solution, the one that was feasible, was to say, going forward, new employees are going to have lower benefit levels. We're going to split the contributions a little more equitably between employers and employees. And then we're going to put some limits just so they're to curb any abuses that might occur with excessive compensation or benefits that get too large. So those are really the main changes of PEPRA, but it takes a long time for those to have a substantial effect on your pension costs, because it only applies to the new people. So their normal cost as it grows starts out very small and then increases over time. But now, 8 years in, we'll see a little bit later that PEPRA is actually starting to sort of bend that cost curve, and you have a substantial number of PEPRA members relative to your overall active workforce. So Deb mentioned this before. I'll just touch on it very briefly. Your Calpers retirement plans, there's actually a number of them, but we'll collectively call them the miscellaneous and then the safety plans. And the miscellaneous covers both classic and PEPRA members, has an unfunded liability about 115 million. The safety, there's different tiers. There's a classic tier. Prior to PEPRA, there's a second tier that really only has a handful of members that were hired before PEPRA came into effect. And then the PEPRA tiers for both police and fire. In total, about 27 million of unfunded liability. But overall, we're going to focus mostly in this presentation on the miscellaneous plan because it has the larger liabilities. So here's a quick look at sort of the number of members in the miscellaneous plan. And this is really interesting because back in 2000, when the plans that are actually maintained and operated by the district were closed to new entrants, all the new folks went into Calpers and also some legacy employees too. So there were no retirees at that time. And then we see gradually over time, you get folks retiring, terminating employment. The red bars are folks who transfer to different Calpers agencies. So they're still earning benefits, but at a different agency. And this is just emblematic of most pension plans. You get this growing difference between the number of retired members versus active members. And I'd say that your plan is actually a little less mature than most who have been in Calpers for much longer, but it's a trend we expect to continue in the future. And it just describes how this plan demographic changes over time in the defined benefit pension system. And we'll talk a little bit later also about the split of these active members between PEPRA and the classic, but it's almost 50% at this point. I think maybe about 40% PEPRA members that are active members. The next chart I want to focus on here is the accrued liability. So this is a chart going back almost 20 years now on the funded status of the miscellaneous plan. And the red line, upper red line, is the total plan liability. So that goes up to about 380 million. And then the blue line is the market value of assets. And that's currently at 268 million. And the shaded area is just the unfunded portion. And the thing I usually point out to most agencies when looking at a chart like this is the red line for the liability is very consistent. Liabilities accrue each year with the normal cost. There's not a lot of spikes. When there are some bumps, that's generally when assumptions about the liabilities have changed. It might be the discount rate or investment return assumption, maybe some of the demographic assumptions, but overall, those liability lines stay very stable. In comparison, it's the asset lines which are the volatile ones. And that's just the nature of a defined benefit pension plan. They have very stable promises, and it's the financing that provides the changes in the funded status for the most part. So this one ends at June 30, 2020. Calpers had really good returns during fiscal year end 21. So once those reports are available next summer, we'd actually expect to see this gap narrowing a bit. And if at any time people have questions, please let me know. I'll be glad to answer them along the way. Lastly, I mentioned investment returns. Here's a chart just showing the historical returns on the Calpers pension trust. And what we do here is we compare those returns not to where they are relative to zero, but where they are relative to the assumption, which is this dotted black line at about 7%. And what we want to see over time is that the actual return is at least as high as this dotted black line. We can see here in 2008, 2009, there were some very negative years, but even in years where there might be a positive return, like in 2015, it was about a 3% return or 2% return, that's still below the expectation, which then increases long-term costs and contributions. Fortunately, as I mentioned, they had over a 21% return this past fiscal year, so that's going to help substantially as it goes forward with the funded status. The other thing I'd point out for your plan is there's this big pool of assets for your Calpers pension plans, and there's, as I mentioned, there's places to fund it, which is contributions or the investment returns, but there's also money going out of that fund all the time in the form of benefit payments. And because your participation in Calpers is relatively recent in the past couple of decades, you're still at the point where the contributions exceed the benefit payments or the outflows. So that means essentially all the investment earnings can stay in the fund and build it versus having to use any of those investment earnings to pay down the benefits on it annually. And that's a good thing. That helps build up the fund assets. As you get to be a much more mature plan, those benefit payments will increase. At some point, they'll likely exceed the contributions, but hopefully that's at a time where the plan has reached a more stable funded status. Moving on, this is the safety plan. We don't have quite as much historical data on that, but a similar pattern as far as the number of safety plan members. It's actually a much more stable population, really staying in the about 70 employees or so for active members combined for the classic PEPRA and the different tiers. Same with the retirees, it's about equal to the active members. So much less variability in the participant counts compared to if we flip back to the miscellaneous plan members, which have increased substantially over the past 20 years. And then also for their liability, just on a smaller scale, what the miscellaneous plan has been dealing with. Overall, both the plans are roughly 70% funded, as Deb mentioned, slightly higher when you combine all of the different safety plans, but overall kind of in the same boat. Okay, so now Calpers contributions, and this is really what many agencies are focusing on right now, is where are our contribution rates going in the future? A lot of uncertainty in the world, and Calpers is making a lot of changes strategically for the long term. And what we want to focus on is when they calculate the contributions that are required each year, there's a couple components. One of them is the normal cost we talked about earlier, which is the value of new benefits. We always want to try and pay those benefits as they accrue, so you're not creating new debt. And then for the existing unfunded liability, find a way to amortize that, pay it down in an orderly manner over time. So there's always these two components to a contribution to a pension plan. And what we've done here is modeled out over the next 30 years or so what those contributions look like. And we've added some history to back several years to show here's the normal cost contribution, and they're shown on a dollar basis in this chart, versus the unfunded liability contribution. So right now you're approximately $18 million total with the normal cost and unfunded liability amortization. That's expected to grow to a little over $20 million and then drop substantially for fiscal year end 27. And that's been on the horizon for a number of years, and we'll talk a little bit about that later. But it's really because each year the unfunded liability that emerges is amortized over a period of time, and it creates these layers. But just want to show this overall pattern of increasing contributions, a drop as one of those layers is paid down, and then kind of moderating contributions that are expected to eventually go to the normal cost as the entire unfunded liability is paid down. Any questions on this chart before I move on?
Mark, it's Deborah Ocker. So this is the model as of the data that we had, the most recent data we have from Calpers, right?
Correct. This is
The layers, and I think you'll talk a little bit more about the layers, but this is an always and ever changing. The kind of the structure of the chart probably won't change too much, and you can talk about that. But with all of the different activities that happen annually, which include the rate of return, the pay of the employees, the number of employees that are benefited, all of those variables come into play, and it changes over time, right?
correct. It's a very dynamic situation, and we can't expect that it will entirely follow this trend, but overall, that's the direction we want to move.
Great, thank you.
Okay, so what the next chart is actually what those layers look like, and we shortened it up just to be prospective from 2022 going forward. But you can see that in addition to the normal cost, that lump, so to speak, of the unfunded liability, it's made up of actually 21 different amortization layers that are cooked in here that Calpers has calculated. And there's one really big one here that gets paid off in the next 5 years or so. And that's the one that will cause a substantial reduction in the pension contributions in about 2026, 27. And there's not many things that are going to change that shape, because when Calpers does an actuarial valuation, the results don't affect contributions for another 2 years. So unless there's a substantial event in the next year or so that would really reduce this by a lot, and it would have to be a very substantial return, 100% investment return or something like that, and even that is phased in over time, you can pretty much expect that your pattern of contributions is going to follow this type of shape.
Mark, can you just say a little bit more about what that layer actually is? Obviously, it's a big layer that's going to change dramatically or go away, I guess. But what is it? What is the layer?
That was actually a pension there. The entire unfunded liability was refinanced, I want to say in 2009. I'm not sure if that rings a bell with Deb and Deborah, but the entire liability was refinanced at that time and amortized over a new period. And so it's been a kind of that constant amount for many years here, and now it's just being paid off, and it's reached the end of its lifespan.
Great. Okay.
We did what was called a fresh start.
Yes.
I'm not sure if they still use that term, but that's what was done in 2009.
Right. It was typical that PERS would recommend that in order to bring your rates down, you could smooth it over a longer period of time. And so I believe that's what the district did.
Yeah, and a fresh start is definitely the terminology that's used. It's essentially kind of like refinancing your mortgage. You say, oh, I'm going to take advantage of new rates. I'm going to re-amortize my debt over a new period of time. Sometimes it can be shorter, sometimes longer, but that's what leads to these kind of larger bases. These other ones, the longer ones that are much smaller, those are typical of just plan experience and how those changes are spread out over time.
So this would, using that analogy of a mortgage, this would be when the mortgage gets paid off in 26, 27. Is that basically what's happening? Okay.
That's exactly correct. Yep. It's like a whole bunch of mortgage slices layered on top of each other. Okay.
And that's good news for our agency because we will be paying less. Is that what you're saying?
We are showing this that our the contribution rates are due to come down when this layer is paid off. However, all the other factors come into play, right? That Mark will talk about a little bit, that will affect the total cost, but the rates are due to come down, you know, along with any other future changes that PERS implements.
There's always a balance of wanting to pay down your outstanding pension liability quickly so you can avoid essentially interest charge on it versus having the actual funds to do so, which is why Calpers is actually very much ahead of the curve, and I'll talk about this later, of limiting how long different pension debt can be paid down over. They use a 20-year period right now. In the pension industry, it was very common to use 30 years or so, which really allowed them to different agencies around the country to extend these payment plans longer than they should have. But Calpers is really at the vanguard of coming up with policies that try to stabilize and put their pension plan on a very stable footing. Okay, I'll move along here. Make sure I didn't miss a page. Oh, I think we're good. Oh, I did miss a page. So here's a list of the pension initiatives they've taken over the past 8 or 9 years. I'm not going to go through each one of them. I will focus on the last two. And one is called the risk mitigation policy. And this is something that Calpers adopted a number of years back, and it's pretty innovative in the pension world, where they have this policy that if investment returns exceed the target by a certain amount, then they're going to take that excess investment return and use it to essentially eliminate some of the investment risk. Now, that bumpy blue line that we saw earlier, they want to smooth that out as much as possible, because the overall Calpers pension fund is getting mature and they're paying out a lot of benefits, and they really don't want to have to deal with years like what they had back in 2008 and 2009 with a 30% loss in their assets. They really just can't deal with that anymore. So they're proactively taking changes to moderate their investment portfolio so it's less volatile. It will likely have lower expected returns, but that's the trade-off you get for having less risk on the table. So that risk mitigation policy was triggered this past year with the high return of 21.5%. So they're going to automatically lower their discount rate or expected investment return from 7 down to 6.8%. On top of that, last week they had a meeting where they adopted new capital market assumptions for different asset classes, and they're in the process of coming up with how they may want to restructure some of their investment portfolio. Once that's adopted in November, there may be additional changes to that investment return assumption. It could go up, it could go down, it could stay the same. It's unknown at this point, but in the next couple months, there'll be more clarity on it. But essentially, they're looking at all the investment options available to them to see, okay, which one of these provides the best return for the risk involved and also aligns with the maturity of our pension fund and the inflows and outflows of the assets. So stay tuned. It's really big news when the largest pension fund in the country is taking these proactive steps, plus they're changing their investment return assumption potentially at the same time. A lot of eyes will be on what the implications are. So this is a quick graphic on how this risk mitigation policy works. It won't be the last time you hear about it. If they exceed the assumed return by at least 2 percentage points, triggers the policy. So that causes them to change their asset allocation to be less risky. With that, it avoids possible downturns or hopes to lessen the impact at least. But there is that trade-off I spoke about earlier. If you have a less risky asset portfolio, it reduces your expected investment return and therefore raises your costs. So it's a bit of a trade-off of a little slightly higher cost for more stability. And this is an illustrative graph. It's not the district's plan, but what it's meant to illustrate is this black line would have been a baseline cost projection for a standard miscellaneous plan this year. If they had fully reflected the 21% return, the contribution rates would have dropped substantially by almost 5% of payroll as after it's phased in 5 years. But with the risk mitigation, that sort of takes away a bit of about half of the investment return effect. So it's just a balance of how do we still recognize some of the good side of having these great investment returns, but not having it, not getting carried away with it, and proactively addressing our pension risks. And so what Calpers does is they provide a modeling tool that agencies can sort of do-it-yourself calculations. And Deb was good enough to put together a baseline model for us, and we did some calculations behind the scenes. And on the next page is a chart, and it's really just 10 years or so. And the black line is sort of a snippet of that chart for earlier that shows sort of this shark fin looking increase and then decreasing in the contributions. So from about $15 to $18 million up to a little over 20, and then back down to just under 15, and then gradually this will go down over time and hit the normal cost. So what we attempted to model, and this is a very rough estimate, is what would happen with the 21% return and changing the discount rate to 6.8%. And there are some recently negotiated pay increases that are going to be affecting the liabilities. And in the end, what we see is there's just a slight increase, net increase in the contributions. It takes a few years for this 21% return to be reflected in contribution rates. Calpers phases those in over 5 years. Once those are fully effective in fiscal 2028, we expect the net contribution rate to just be slightly lower than it otherwise would have been. So I'll pause here and see if there are any questions on these contribution projections, if Deb and Deborah have any background they want to add here.
This is a great chart. Like Mark said, Deb and he worked on putting some of our own data in there. So the charts you saw before were based on just the data that PERS already had as of 2020. And we were able to put some of these new changes in, the changes that PERS has that we just talked about, and our wage increases. I think there are built-in assumptions for wage increases. Mark, you know what those are.
Correct, yeah.
2 to 3% annually, I think, in the model,
Correct.
PERS model. But we wanted to reflect our current agreement that we just, our current MOU that we just put into effect. So that's great. And I also wanted to point out that our next item on the agenda, we'll talk about it more, but when we created our pension trust, we saw this amortization layer. We saw that the rates are going up pretty significantly and then coming back down just below what they are in 2021. And that the pension trust was really to help us smooth the rates and provide some stabilization for volatility that happens. You can see my skepticism because I have been working with PERS over my career, and things happen. There are things that happen that they don't plan, that hit us by surprise. And so when I keep repeatedly saying there's going to be things that come up that shift these charts, that's just based on experience. And Mark is speaking of the new policies that they're putting into place that are trying to reduce those types of sharp spikes and eliminate that type of uncertainty that has happened in the past with PERS plans. So this is all good news.
Well, good to know. So Elizabeth, did you have a question or?
No, I'm just listening. I think I understand so far.
Me too. And you're a little deep in the grass for me here, so.
Okay, well, we'll try to liven it up a little bit for the last few slides. And we'll look into the future a bit of where these are going.
We need to wind it up. Yeah.
Okay. So the last parts, I mentioned this earlier, there will be a new investment return assumption in November. People will be waiting on the edge of our seats for that. That's quite a big effect if they make any changes there in addition to the recent decrease. And I'll just highlight again this proactive management of the investment risk. The pension stabilization trust that was developed a number of years back. This is just a brief illustration of how it works. The district has required contributions to Calpers each year, wherein those are paid through the monthly benefits to retirees. But many agencies have set up these stabilization trusts in anticipation of those spikes, the big peaks in contributions. So ahead of time, you optionally put money into the trust, so it's available as needed to help moderate the strain on your annual budget. You can pull money from this stabilization trust to help supplement your required contributions.
Mark, can you just go back just for a second to the previous slide? No, one forward.
One forward. Okay. Yep.
Right. So this one, the changes to forward-looking capital market assumption. So does that mean if their assumptions about the capital market going forward is they're expecting even better returns, then they're going to reduce the discount rate more? Is that what that means? Or can you just clarify what exactly that will do?
Sure. It's close. So generally, investment advisors' view of future investment returns, both for equities and fixed income, is that they're going to be lower in the future than they have been historically. And that's the trend we've seen for a few years. So if that happens, then that would decrease the long-term investment return assumption, which would increase liabilities. Lower investment returns means higher contributions required. How Calpers deals with this, because they're so large, is they look at asset classes like private equity and other asset classes that aren't available to normal investors, and where they think they can get higher returns. So it's unclear, the public equity stocks and bonds that we as individuals might invest in, those have lower expected returns, but some of the private equity that only really large funds have access to, some of those expectations are pretty high. So it's really, how do they blend those all together with their new investment policy? Does that make sense, Dr.
Yeah,
Arthur?
kind of. The reason why it was unclear is because if you're reducing the discount rate because we got a really good return this past year, so you're going from 7 to 6.8, but then if looking forward, you think your returns are going to be less, then you're looking at then you're going to be looking at a discount rate of less than 6.8%. But I guess I'm not. Yeah, it seems, I understand. I mean, I understand about how it could be riskier, so they're going to have a lower discount rate, but it just seems odd to move it from 7 to 6.8. And then if you think it's going to be a worse risk, discount it even further.
Yeah, it's all part of their path to avoid volatility. And so they've said, we've got lucky this past year. We had a really high return, and we are going to de-risk the plan, moving to 6.8%. But really, the change in the capital market assumptions is almost an entirely different decision, just based on their investment advisors saying, you used to assume stocks would earn 8%. We're telling you it's going to be 6% now. That's just sort of a shift in the landscape, not necessarily a decision on Calpers' part. It's just advice that they're accepting.
Right. Okay. But so if the investment advisors thought that looking forward that you could get 6.8, would they leave it at 6.8?
Yes.
Okay. All right. That makes sense then. Okay.
Okay. Good questions. Good question. All right. So winding up a little bit here, this is the illustration showing how a pension stabilization trust is intended to work. Your plan with this black line that has kind of the peak here. If you draw funds from the pension stabilization trust over the next few years, it's intended to moderate, essentially move that down to this blue dotted line. And the difference here would be funds that are withdrawn from the pension stabilization trust. And I'll reemphasize, the whole point of these stabilization trusts is to use the money when you need it. Not that it wouldn't do you any good out in the future here, but those are really sort of shorter term investment vehicles. They're more geared towards fixed income securities with lower expected returns. Once you put them in the pension trust, then they're invested for the long term with Calpers, and generally a higher expected return than they would in the pension stabilization trust. Kind of going along with that is additional discretionary payments. I'll just really briefly, these are just extra money you give to Calpers above the minimum required. And the intent there is to pay down the interest on your pension debt sooner. So you pick one of those layers, work with the Calpers actuary to say, I would like to pay off this longest one first, save the most interest, and then kind of they're entirely optional, but to reduce those long-term costs with the additional contributions. You could even do it with funds that are in your pension stabilization trust. You could take the entire amount, give it to CalPERS and say, I want to lower my pension debt based on eliminating these 3 layers. And then you just wouldn't have that stabilization trust to reduce annual budget changes in the future. And then lastly, PEPRA, I mentioned this earlier, it's really starting to make a difference. Active member counts, classic 350, miscellaneous, almost 300 for PEPRA. And on the safety side, about 47 classic and 26 for safety. So we're really seeing this shift in how employee demographics have adjusted over time. These charts show the normal cost contribution rates, and PEPRA requires a roughly 50-50 split. So that's one of the cost sharing mechanisms, whereas we see with the classic members, they can be quite different. They're not necessarily a 50-50 split. So that's something to look forward to. Your contribution rates in the future, once you're essentially 100% PEPRA, those costs are split evenly. It's a generational equity issue.
So was PEPRA something that Caltrans initiated and we needed to accept? Or what kind of leeway did we have over PEPRA at the time?
None. It's the state law. You had to comply with it. So all public agencies in California have to comply with PEPRA.
Okay, because I recall at a certain point in one of our MOUs that we talked about this issue for new employees receiving a different type of benefit. So when we talked about that, was that just a given from our CalPERS? Wasn't something that we could decide as part of the MOU?
Director Lane, yes, the governor and the state legislator changed the law for all members of CalPERS. You may have recalled conversations of cost sharing. And so there were some groups of employees at some agencies where the employees negotiated that they would pay more than what this chart says. So for instance, our sworn members are required to contribute 9%. But I think our agreement is more than that. And Michelle's not here today, but Deb, do you remember what our sworn?
Yeah, they pick up an additional 3%.
Right. So they're actually contributing 12% instead of the minimum 9%. So those were maybe some of the conversations you recall that were related to cost sharing, and they mostly happened with the sworn public safety agreements.
Okay, thank you.
Okay, last couple of charts here. This one just illustrates the effect of potential changes in the investment return assumption. Here's where you are currently for the miscellaneous plan. I'll just point out if there was a 100 basis point reduction down to 6% over time, that has about a 13% increase in the accrued liability, which flows straight to unfunded liability. So just to give you an idea of this relationship between how the discount rate and investment return assumption changes, and then the effect on the liability. The solvency liability, this is really a item that CalPERS publishes. If you wanted to get out of CalPERS, how much money would you need? And so you'd need almost another $400 million if you wanted to terminate your contract with CalPERS. So that's why very few agencies, if any, voluntarily leave the CalPERS system. Other considerations, demographic patterns. Part of the recent CalPERS experience study is demographic changes. They're not expecting them to have a huge increase or effect on contribution rates, maybe 0.5% up or down on the normal cost and the unfunded liability. Same with COVID-19. They said in their reports that they really don't think it's going to have a long-term effect on the fund's overall costs, at least at this point. And it really is just speculation at this point. We're still relatively early, though it seems like a long time into the pandemic. But as far as understanding the long-term effects, that data is just being gathered now. So maybe in a couple of years, there'll be more evidence about what are we seeing with regards to the pandemic on pension plans. And I believe this is the end that, eventually we expect these contribution rates to move towards that normal cost, that Calpers is being proactive in trying to manage this risk. And I'll just reemphasize this point about the pension stabilization trust, that those funds are intended to be used, and I'd encourage you to use them while they're most useful, which is probably in the next few years as you approach that sort of peak in the contribution requirements. That's all I have to say. I'll take any more questions that you might have.
Okay, I see Director Corbett has joined us. Welcome.
Thank you very much. My apologies. I had a technological problem.
You were not alone. Okay, so Elizabeth, did you have any other questions?
No, I think I'm good for now. Thanks.
I think, for years there was a resentment of Calpers jumping around, shall we say, in terms of providing surprises to agencies. And so this sounds very positive to me in that they're taking a look at stabilizing it and not having these kinds of surprises. Am I hearing that correctly, Deborah? With your, financial experience.
I believe that is their intention and that is their goal. And I can recall being at a conference before COVID and actually speaking to the actuary and saying, we are very happy that you are doing things to protect the long-term ability for this plan to continue. So that is, I believe that's their goal. I think Mark would nod and say that that's their goal.
Yes.
And then the other thing that I just want to say, and it's been a while since I've been on finance. I'm not really crazy about the word miscellaneous, especially when it comes to describing funds. And so from my vantage point, if you could, here we are with classic, and some other things. If you could ponder something that wasn't quite as amorphous as miscellaneous for this, I would appreciate it. So.
Yeah, we can put in some description of what that means.
Something, yeah. Okay, so when you were talking initially about 1998 with 138% and then dropping to 61% funding, what's the ideal percentage? Or is there an ideal percentage?
Well, PERS will right now say that their target is to be 100% funded. A former actuary that I used to work with would say, you never really, to a public agency, you never really need to be 100% funded because it's always kind of going up and down. But I'm not sure what Mark, our current actuary, what he recommends for a target for funded status for agencies.
Definitely 100% is always the long-term goal. In great times, you probably want to be up around 120, and in poor times, go down to 80, but somewhere in that range, with 100 being the goal. That's a long ways off. I have worked with another agency that has their own plans that hit 100% this year, and just take a breath. It's momentary. It always fluctuates, as Deborah mentioned, but that's the long-term goal is 100%.
Okay, thank you. All right, are there any other questions, comments? Director Corbett, do you want to say anything about your experience with Calpers?
Well, based on what you just said, if things are becoming a little more practical and evened out, that's good news.
All right.
And CalPERS needs a crystal ball is what they need, and that would help
Yes.
predict. Yeah.
Okay, so this is an informational item. Are there any other comments that staff wants to make with regard to this? Okay, thank you very much, Mark, for the presentation. Very enlightening.
Thank
We
you.
appreciate it. Okay, our next item is item 2, and that's annual report on Park District Pension Trust. Speaking of which.
All right, Deborah Spalding, Assistant Finance Officer again, and I'm following up on our CalPERS item. We've got a report on our pension trust. And again, I'm going to give a brief overview of what our pension trust is, some of the history, and then I'm going to turn it over to our consultants who are here from PARS and from Highmark Investments. And they're going to give you a bit more detail about how our pension trust has been doing. So some history, back in 2017, our actuaries, again, continued to give us advanced information about what was on the horizon for CalPERS. And we could see that our costs were going to be increasing in the future. And so there was a relatively new method of setting aside funds in what's called a Section 115 trust. And you can use that for your OPEB, you've heard us talk about our OPEB trust. You can use that for your post-employment benefits, but there was a new ruling that said you could use this for pension costs as well. So in 2017, we adopted a pension trust and we put 3.5 million into that trust. And our idea, not necessarily that it was going to earn higher returns than CalPERS, but that we were diversifying our baskets, not putting all our eggs in one basket, and that could be providing stability, and that it could be drawn on later to smooth out the increases, which we saw coming. And so by the end of 2021, we'll have transferred 9.5 million into that trust, and we have earned over 2 million as of July 31st. So that's worked out well so far. And the plan in this coming budget year, 2022, is for us to start drawing down from that pension trust. We're going to take 2 million out and reimburse ourselves for our miscellaneous plan pension costs. So that is my brief overview. And we have Anthony Armas here from PARS and Randy Yurchuk from Highmark Capital Management, and they're going to provide you with some additional details.
All right, thank you.
Perfect. Thank you for that, Deb, for that overview and introduction. Let me go ahead and get our presentation pulled up. Can everyone see that okay?
Yes.
Perfect. All right. Good afternoon, everyone. Good afternoon, Board Finance Committee members. We wanted to thank you for allowing us and our team to be here today. My name is Anthony Armas. I am the district's client services coordinator for the program. And then we also have Mitch Barker, who is the lead consultant for the program as well with PARS, who was unable to attend today. But with me, I do also have Jennifer Mesa, a manager in the consulting team with PARS. In addition to Jennifer, we also have Randy Yurchak, the Highmark Capital Management portfolio manager. Just to give the district a brief overview of the trust team and the different responsible parties, we at PARS serve as the trust administrator and consultant for the program. We serve as the record keeper. We coordinate all agency services, monitor plan compliance on an ongoing basis, and we serve as the district's central point of contact for any ongoing questions or administrative needs. One of the responsibilities or functions that PARS does not handle is the holding of the assets or funds that is actually directed to our trustee, US Bank, who is the 5th largest commercial bank in the nation. So they are the plan's fiduciary and they safeguard the plan assets. And then last but not least is the investment manager, which is Highmark Capital Management. That's where Randy and his team come into play. They are a sub-advisor to the trustee US Bank, and they handle all the investment related business for the ongoing pension plan. Here's just a list of the different plans and programs that PARS does administer and offer if at any point in time in the future the district wants to review any of the additional plans that we do have available, we can certainly set up those discussions. But in today's presentation, we'll be talking about number one, the pension rate stabilization program, which is part of the 115 combo trust. And of course, if at any point throughout the presentation, anyone has any questions, feel free to stop me and we can take those as they come. Just to give a little bit of background on the Section 115 trust and the PARS team. PARS was actually the pioneer for the 115 trust. Back in 2006, we received a private letter ruling from the IRS to allow this 115 trust. And then in 2015, we were the first provider to have the private letter ruling for the combination 115 trust. That way you can pre-fund OPEB and pension obligations within this combination trust in two separate buckets. For today, we'll be focusing on the right-hand side for the pension rate stabilization program for pre-funding pension obligations. This is an irrevocable trust, meaning all contributions or assets in this pension trust can only be used for pension-related obligations, such as reimbursement to the agency for pension-related obligations or even paying the retirement system directly. Now, the next few slides is just a client list of the different agencies that we work with the OPEB and pension side. So we wanted to take this time to thank the district for allowing PARS for your business, for your trust in us and Highmark Capital to administer this ongoing program for you. Now, I won't dive deep into this slide since Mark was able to provide a much more in-depth conversation and overview of the Calpers pension obligations and had much more recent data based on the 2020 evaluation that was made available. So again, won't touch too much on this, but here are just the projections from what we had available. Now we'll go ahead and dive into your specific district's pension plan. As Deb had mentioned, this was made effective back in September of 2017. With the pension plan, there is a co-plan administrator relationship. So that's the general manager, Sabrina Landreth, and the chief financial officer, Deborah Ocker. So they are the two individuals authorized at the district to make any updates or changes as needed to the pension program. And the account is currently invested in the moderately conservative Highmark Plus active strategy, which is within its own individual account. And that's something that Randy at Highmark will touch further into in his portion of the presentation here. Now, the bottom portion of this slide is an overview of the account, and this is as of July 31st. So I'll run through this briefly and provide some updates on the very next slide with future contributions and reimbursements. So the initial contribution, as Deb had mentioned, was made back in December of 2017 of $3.5 million. An additional $5.5 million since then, totaling the contribution since inception, currently at $9 million. And the account has experienced $2.1 million worth of investment earnings, putting the account balance, again, as of July, at $11,019,000. Now, the next slide here is just a graphical representation of what we just touched on. So you can see a breakdown through each of the fiscal years and how those contributions had been made into the program. No disbursements made, and you can see how the assets have grown over time. Just to provide some updates, as of August, that account balance is now at $11,088,000, so about a $69,000 increase for the month of August due to investment earnings. So that performance has continued to grow the account balance. And Deb did mention that by the end of this year, we'll have $9.5 million worth of contributions. I can confirm that in September 9th, $250,000 was made as a contribution into the program. So we're expecting that final $250,000 by the end of the year, which will just continue to grow the account balance. Another item that Deb did mention as well in the agenda and her overview was the $2 million worth of disbursement from the program sometime in 2022, and subsequently an additional $1 million in contributions from the program as well. So one of the flexibilities and beauties of this type of program is the contribution disbursements as needed by the district. There's no yearly minimum, no monthly minimum. It can happen at the district's discretion, and there's no fee for withdrawing or putting in money either. With that being said, I'll just pause if the district had any questions before we go into the investment portion of today's review.
Okay, are there any questions for Anthony? Okay, please proceed.
All right, perfect. Sounds good. Randy, I'll go ahead and turn it over to you.
Okay, thanks very much, Anthony. So in the PARS program, we have 5 different investment objectives. Go ahead and flip to the next slide. Thank you. The investment objective for East Bay is what we call the moderately conservative investment objective, and this is in the active program, or the active style, if you will. So moderately conservative is 30% stocks. So that provides basically the inflation protection. It will be the component that grows the account over time, and 70% bonds and cash, which provides stability and some income. The investment account is in the active plan. The active meaning that we're selecting actively managed mutual funds seeking to outperform the benchmark. We do have 2 different styles. So we also provide a style that has just index-based funds. The active style gives the opportunity for the district to outperform the benchmark, and actually we have done that in the plan, so that was a good decision. In terms of the allocation of the account as of now, we're at 31% stocks. 30% is the long-term allocation. So right now, as you can see, we are overweight stocks. We're also overweight bonds, 68%. The long-term benchmark allocation, 65%. We underweight cash at slightly under 1%, 5% is the long-term. So effectively, we're underweight cash because it's not yielding anything. As you're likely aware, federal funds rate is 0%. You probably see that in your general fund at a very, very low return. The return for the plan since inception at 7.4%. So it actually significantly exceeds our long-term 30-year projected return for the moderately conservative investment objective. We do expect 5.1% over the long term. So that has significantly outperformed our expectations. I would echo, we did sort of reflect the same thing that Calpers did in regards to our long-term return expectations. We review those long-term return expectations once a year in the April timeframe. And being that the fixed income markets had appreciated so much and the yields were low on bonds, what we adjusted our allocation down for our long-term return expectations because partly of that and partly because the valuations on the market were had increased quite a bit. So if we were speaking back in a year ago, our long-term return expectations would be closer to 5.5%. So 5.6%. So our return expectations actually have come down along with Calpers. Just want to note that. If we flip to the next slide, we break down our returns in the plan across these different asset classes, what we call asset classes or sub-asset classes. So it being that that we are using mutual funds that seek to outperform the benchmark, you will see variance between the return of the plan and the benchmark. The return of the plan is characterized by the black letters, the black line item, and the italicized amber letters beneath that represent the benchmark for each of the different sub-asset, or for each of the different asset classes. So over the last year, you can see our fixed income managers have done a good job of exceeding the benchmark. However, of course, as returns vary over time, we're about in line with benchmark on the inception to date time frame. For large cap funds, also exceeded the benchmark, and as of course, equities a big winner here because of course, basically the recovery in the economy, the significant stimulus both on the monetary side and government stimulus with regards to all the rescue plans. Basically, it really gave investors confidence to keep buying stocks. Basically. Small cap funds, you can see there up 52%. That was the big winner. But thinking back 1 year ago in July, that was one of the most hardest hit sectors, and so that one has come back the strongest. As you can see in the inception date performance, though, 14% versus 12% benchmark. So our small cap managers have certainly done well relative to the benchmark. And then international, not as strong return. Effectively, the stimulus over there has been much less than America, as well as we know that the COVID situation has been more harder hit and slower to receive vaccines on the international stage. And REITs, of course, as we all know, they got hurt because of everything closing down, but they're starting to come back. On the next slide, it shows each of the funds of the plan, as well as the mix of investments. These are areas in which we can tweak up or down based on our viewpoint. We call tactical allocation. So over a 12 to 18 month time frame, we'll adjust these based on our outlook. We're actually overweight small cap now. That was a recent change, so it's not reflected in this report. But we're overweight small cap relative to our benchmark allocation. Just given the fact that it has lagged large cap, and we think that the economy will continue to move forward, and we won't have a sustainable hiccup anywhere. So it'll eventually lead to a resumption, if you will, in small cap returns. And then page 11 and 12 are, or 23 and 24. These are all the funds in the plan with trailing year return history. Just provide context in terms of how they've done relative to each other and relative to the benchmark. And then we always like to wrap up with our crystal ball comments. Obviously, we're tongue in cheek a little bit there, of course. Crystal balls are always cloudy. Our expectation, though, is that we think that the recovery will continue. We've certainly seen some hiccups with regards to the variance. Certainly, we might see more of that. And a choppy recovery. We've got all sorts of issues on the global stage. Evergrande, as we're all aware, and a potential financial contagion in China. But I think with all that and knowing what we know in regards to policy leaders across the globe, we as of now we think that the recovery will continue. And the risks are manageable at this point in time. We do think that we do think stocks will still remain the preferred asset class and remain overweight. Any questions?
Okay, any questions for Randall?
No, just thank you for the report. It's very interesting and very clear. So I don't have any questions at this point. Thank you.
I like your crystal ball, so for what that's worth.
Always cloudy.
Always cloudy.
We're all about full disclosure. We don't have great visibility, but we do the best with what we can, right? So far, so good.
Don't we all? Yes.
Yes.
Okay.
Thank you, Randy.
Thank you.
Okay. Thank you very much, and thank you for providing this the materials beforehand. That was helpful. All right. So staff has nothing to add. Thank you to both of you for the presentation and to staff for setting this up. Staff have anything else to say on this item? Okay, let's turn to number 3, which is our green bond annual report for 2020.
All right. This is an annual report that we bring to you around this time every year, at least we have for the last 3 years. And we basically just do a look back on the green bond spending that we've been doing. And the reason we do this is that it's required. This is we have to create this report and submit it to the MO website, which is the MSRB requirement. And so we bring it to you as well, just so you can see what's been going on with our green bond spending. So what were our green bonds? So back in 2017, we issued $30 million in green bonds of the total $80 million WW issuance that was done. And that was a relatively new category at the time, that you could issue, at least for municipalities, that you could issue bonds as green bonds. So green means that they can only be used for certain kinds of projects that have an environmental benefit. And so for the Park District, we set up 4 categories that we said we could use our green bonds for: land acquisition, habitat improvement, sea level rise response, and trail creation. And we excluded other categories such as recreation projects, parking, restrooms, and visitor centers. And so of that 30 million that was issued, of the total 80 million, we've spent 77%, about 23 million as of December 31st, 2020. So that's the overview. And then I'll just walk you through a few of the projects that were completed in 2020. And these are all in your packet. So here was one that you may recall, the Almond Ranch acquisition. This actually is owned by the John Muir Land Trust, but we have a conservation easement over this land to protect the endangered species on it. And it also provides a connection in the Bay Area Ridge Trail. And so we do a calculation each year where we talk about, well, what is the green benefit? So we calculated, so there's 281 acres of rangeland, and that annually will sequester 257.58 tons of carbon dioxide. And so we've protected this for the future. And moving on, we have this San Francisco Bay Trail connection down at Albany Beach. And it's a combination of a trail that's widely used, but also had some environmental restoration, some habitat restoration that was done there. In total, we spent 4.8 million in green bonds, and we've calculated a small carbon sequestration value based on the small amount of land down there, but I think there's also additional benefit. Wasn't able to quantify it based on people using that trail for commuting purposes. So possibly people are not driving because they're able to ride their bikes on that trail. And the last one we've got here is the Smith Guarini acquisition at Las Trampus. This is a narrow inholding, but it connected the park boundaries at Las Trampus and extended the Rocky Ridge View Trail. And we calculated 170.9 tons of carbon dioxide sequestered annually from this acquisition. So that's it. I'm happy to take any questions if you have them.
Well, I do have a question. I can't recall what percentage we have spent on the other WW bonds to date. Do you have that figure?
I don't have the exact number, but of that issuance, we have about, I think it's 23 million of that. So we did an $80 million total issuance in 2017. And I believe we have about 27 or 28 million remaining. And so we're looking at whether or not we're going to be doing our next WW issuance this year or possibly next year. Depending on how quickly we think we're going to be able to draw down those funds, because there's a requirement about how quickly you need to spend bond funds.
Mm-hmm.
So we don't want to issue them before we're ready to spend the money. So we're actually speaking with our bond advisors next week about this. And there are certain advantages to issuing the bonds now, but again, we don't want to issue them before we're ready to spend them.
Okay, well, I know we were discussing the possibility of going out this year, but I can see we're a little late for this year at this point. But when it comes to spending the green bonds on the areas that we're committed to, have we had any problem finding areas in which to spend these funds?
Not so far, since acquisition has been a major use of the funds, and we've had some significant acquisitions since 2017. That's been a lot of the spending. And then some of our trail projects have also used up a lot of those green bond funds. So I'd say we're spending the green bonds maybe slightly more quickly than we're spending the non-green bonds, but they're about on par.
All right, thank you. Any questions?
No, this was very exciting when we put this together in 2017. So we always appreciate putting together this report. Deb just highlighted a couple of the programs, but from the whole, work plan of WW, it was always 75% acquisition, 25% development. So there's lots of work to be done. So we do envision having the opportunity to issue more green bonds and utilize those pretty well.
All right, well, I wasn't on finance when, in 2017, and I remember the discussions of it at the board, and I thought it was really very intriguing, but we were doing some innovative activities, the green bonds, I think, at that time.
Yeah.
Okay, so this is informational. If there are no other questions, let's move then to our next item, which is number 4, our Beacon Economics
All right,
tax forecast.
yes, this is your last item of the day, and again, it's an informational item. And again, this is something that we do annually. We contract with Beacon Economics for them to provide us with a 5-year of assessed valuation in the 2 counties. Again, a little bit of history about Beacon Economics. We first started working with them in 2009, and that was right after we passed the Measure WW bonds. And suddenly assessed valuation crashed, and we were trying to figure out how to structure the bonds in order to ensure that we'd be able to keep that promise to voters of $10 per 100,000 of assessed valuation. So we had to be very careful about not breaking that promise. And so Beacon provided us with a 5-year forecast of what they thought was going to happen with assessed value. And I've pasted that chart here so you can see it was pretty bleak. So they were saying assessed valuation was going to be dropping for the next 4 years. Their low projection had it dropping 4.7%, 7.8%, and even their high projection had 4 years of assessed value decreases before starting to recover. So that was why we first started working with Beacon Economics, was so that we could think about how to structure those WW bonds. But we also use them for our 5-year projections and for our current budget forecasting. And so that's been actually just as useful. And so we this year got their report, and it was included in your packet. And in case you didn't get around to reading every word of it, I just excerpted a few highlights from that report. So they give us information at the national, the state, and then the local level. And so just some of the highlights. So they said at the federal level, highly vaccines have substantially decreased the risk from COVID-19. So spikes in cases will really just push growth to the following quarter rather than leaving any lasting impact. So they really don't see that COVID-19, even though it's not quite under control, that it's going to have a negative impact on the economy. California, one of the interesting comments they said was they noted that our workforce has not recovered to where it was before the pandemic, so we have higher unemployment still. But there have been significant productivity gains, and so actually the economy has recovered because we've had that big increase in productivity. And then in the East Bay, they really hone in on property values. And so they gave us information about residential, industrial, retail, and office real estate. So they said strong economic growth and increases in household wealth will lift prices in the residential and industrial real estate markets, but retail and office will remain sluggish or decline. And they were really quite negative about the office real estate space. And so it's kind of a tale of two assess values there. Unfortunately, the residential is going so well that it's offsetting the decreases in those other areas. And so here's a comparison of the forecast that we got from Beacon back in 2020 last year and the one that we got this year in red. So you can see last year's forecast was less positive. So they had increases bouncing back after the 21-22. I shouldn't say that our rates, they did decrease from what they were. So they were around 6% and came down to about 4%. And they projected that they would go back up to just a little over 5%. And then this year's projection, they're saying that actually there's going to be quite a jump in assessed value, getting up to mid sixes and even into 7% in 2023-24. So this is quite a positive forecast. So as I mentioned, we use the Beacon projection in our budgeting. So they give us 3 different forecasts: low, baseline, and high. And baseline is like medium. And so we take the known assessed value increase from the 2 counties. So we know what it's going to be for the first half of 2022. And that was 4.6% for Alameda County and 3.4% for Contra Costa County. And we combine that with the baseline forecast that we get from Beacon for the second half of the year. And so when we combine those 2, we get an overall budget increase of 7%. And so I'm talking budget to budget. You may be thinking, gosh, that seems high. And so I want to look back at last year. So last year we used the low forecast from Beacon. As we received the 3 projections, we used the low one. And so the increase in our budget this year is going to be 7%. And then here's just a screenshot of the forecast and the 3 different options that they provide. So the low and the medium and the high. So we're using their baseline forecast along with the known increase from the 2 counties for the first half of the year. And this is an informational item, so no action is required, but I'm happy to take any questions you have.
Okay, some questions for Deborah.
Sure. So the short term looks really excellent, especially for the residential. But I was curious, when you put the graph up, it also showed a decline after it goes up to 7% and then it starts coming back down. And I was just wondering if they'd given you some reasons for why that might happen, because I maybe more residential properties on the market or something like that, but it does seem that well, anyway, I'd just be interested to know what.
They did not specifically say anything. Deborah, weigh in if you saw anything in there, but that actually does tend to be 5.5% tends to be where their forecast in the out year always ends up. And I think sort of like Randall's crystal ball being cloudy. That they tend to go back towards the mean, revert to the mean in the out years. And I think 5.5% has been sort of the overall trend over time. But they did not give anything to say they think something particular is going to happen that I could see.
Okay.
I agree with that. I don't think they have particular things that they're counting on. I think there are maybe, as the longer the years go out, maybe a little more conservative. And also they look at the history of economic cycles, and we do see cycles going up and down. So probably part of their model, and we can confirm that, is that economic cycles do go up and down.
Thank you.
So I do have a question on the budgeting. Last year we used their low. Did using their low, was that responsible for so many funds for our mid-year discussions?
So the assessed valuation is really calculating the secured property tax mainly. We have categories of property tax that come to us, but the assessed valuation that Beacon provides is really showing the growth of that secured roll, that 1% property tax. And we pretty much hit the target of secured. We did have more revenue in the area of redevelopment, dissolution, where we get funds from all the other taxing entities and it comes to us. And it is much more challenging to estimate those numbers. So we did have a variance better than budget in that category. And I think maybe an unsecured property tax had also a positive variance, which did add to our mid-year savings number. The majority of the mid-year savings was due to not spending all of the funds that were budgeted due to various situations.
Yeah.
I'll just add, so what
Yeah.
we used the low forecast for this current year that we're in for 2021. And
That's right.
so it does appear that we are going to end up being over budget. That we'll receive more revenues than we had budgeted in 2021 based on us using the low forecast, and it's actually been more like the baseline forecast. So I think our thinking back, we had put in like 3.5%, and it's really coming out about 4% is what the assessed value, 4.2%. I can't remember the exact number. We underestimated, and that's going to show up in next year's mid-year.
Thank you, Deb. I was speaking about 2020. Deb is now speaking about 2021, and the report is projecting for 2022. So you're right, 3 years we're spanning.
Oh, okay. And so because of our experience this year, is that why we're going with the higher figure for next year?
Yeah, we typically use the baseline in our projections. This is the first time that I can remember that we used the low. I think it is the first time that we used the low projection. We talked about, again, you know, should we do the baseline, and that's what we're doing.
Okay, so you're not doing the high, you're doing the baseline.
We're going to do the baseline again.
Okay. Okay. All right. Well, you know, I always, you know, I look at companies like Beacon and others who do these forecasts and think often of that smoky crystal ball. But Beacon has really done pretty well, haven't they?
Yeah, we had the chart that's in the report, and it shows that they're, you know, they're within, you know, I think 1 year they hit it exactly, but they're always within, like, I don't know, pretty close, within a percentage point.
Mm-hmm. All right, so are there any other questions? Okay. Thank you for this informational item again. So are there any public comments?
Hi, no, there are no public comments. Committee Chair Lane, we did have one comment earlier from Tara in the chat that Deb answered, so there's no outstanding public comments, I should say.
Okay, all right, thank you. So then, yeah, and we have several opportunities for people to do that, Zoom, email, and voicemail. All right, so next we have committee comments. Staff is in the middle of budgeting, is that correct?
We are very busy into budgeting, and we're happy to have our new general manager working hard with us through this process. So at your October meeting, which is currently scheduled for October 22nd, we will be able to give you a little taster of what's coming in the budget. Typically, we like to give a little bit of a preview what's coming in the November Finance Committee, which is a lot more details about our proposed budget.
Okay, and so it's September, so I'm going to weigh in on need to pay attention to support for the cultural resources coordinator. We are finding that they're calling her up and putting her to work, and I think that one person is not enough to handle some of these things. So I just wanted to put that as my September comment, because I know you are having these discussions about future positions. And I suppose you'd be shocked if I didn't bring that up.
Thank you.
Okay, so are there any other comments from Elizabeth? You had some comments?
Well, just in general, thank you very much for all of the information, the reports. I thought this was a very informative meeting and also very efficient. So appreciate that.
Yeah.
When can we get copies of the first set of slides from the first presentation? That would be helpful too.
Yes, we were working up on that presentation until the end, but we can email that to you. And I do want to thank Deborah Spalding. She did have a lot of work to do on this committee, and as always, she does a fantastic job. So thank you, Deborah.
Thanks.
Okay, and I'll add my thanks too. I did notice that our November 22nd meeting is on a Monday, so that's a little different than what we usually do.
Yes, we have for the last several years, we have found that that Monday meeting before Thanksgiving seems to work best, so that the Finance Committee is able to meet and discuss the proposed budget before the first meeting in December, before the first board meeting.
Mm-hmm.
I look at my calendar. Yeah, this is a year where November 29th is also a Monday that would be after the holiday. If any directors have a problem with the 22nd, we could consider November 29th if nobody was on holiday or anything. That makes it very close to the December 7th meeting, but I think we could, if it needed to be changed.
Yeah, I just noticed that it was a Monday as opposed to a Friday.
That's correct.
Elizabeth, did you have a comment?
Well, I was just gonna say the 29th would be a little better for my schedule, but that I can make the 22nd work too. I'll just school's out that week, but either way, it's good. I can do it.
Does it rush you at all to do the 22nd? Would the 29th be better for staff in this presentation?
I think we would love an extra week. The proposed budgets will already have been delivered because we want to make sure all the board members have enough time. But yeah, we would be happy to take the 29th. Maybe I can check with Director Corbett and see if she needs a schedule change or not.
Okay, because I'm game for whatever. So why don't you check with Ellen about that?
Yeah, and I can do either. So yeah, but yeah, just check. But if the 29th is better and you don't think it's too rushed ahead of the board meeting, that would be preferred.
Okay, great. Thank you for that. We will get back to you as soon as possible.
Okay, so is the plan again to get us the budget so we can dedicate our Thanksgiving weekend to it?
That is always the plan, Director Lane. We do try to get it to you by, the Friday before the Thanksgiving week. That's our goal.
Okay. All right. Well, if there are no other comments or additions, then we are adjourned. Thank you, everybody.
Thank you,
Thank you.
everyone.